So moderating our panel discussion today is Dr. Lydia Olander. Lydia is a program director in the Nicholas Institute for Energy, Environment, and Sustainability and adjunct professor in the Nicholas School of the Environment. Her work focuses on improving evidence-based policy and accelerating implementation of climate resilience, nature-based solutions, natural capital accounting, and environmental markets. She leads the National Ecosystem Services Program Partnership and serves on Duke's Climate Commitment Action Team. Lydia recently spent 2 years with the Biden administration at the Council for Environmental Quality as Director of Nature-Based Resilience, and before that, 5 years as on the Environmental Advisory Board for the U.S. Army Corps of Engineers. She's a fellow of the American Association for the Advancement of Science and a widely published researcher. Lydia, I'll hand it over to you.
Okay, great, thank you. All right, well, I'm honored to be here and moderate this distinguished panel that builds off the wonderful remarks from Frank. I'm just gonna quickly introduce our panel and then we can jump right in. So Francis Bouchard has already been introduced. So he's our Duke University Climate Leader in Residence. We also have Allison DeJong. He's a planner and policy researcher at the Water Institute, an independent nonprofit applied research organization where she leads and supports projects for urban resilience, greenhouse gas mitigation, climate adaptation, and decision science. Allison is the insurance focus area lead for the Water Institute of the Gulf Center for Equitable Climate Resilience. Our next speaker is Roger Grenier, who is the Senior Vice President of the Global Resilience Practice at Verisic, a global data analytics and risk assessment firm. Roger helps government and NGOs prepare for disasters, promote awareness of the protection gap, and helps clients make more informed resilience decisions. And Mahmoud Raya is an associate director in the Financial Institutions Energy and Climate and Sustainability Practice at Boston Consulting Group. He has significant experience in climate and sustainability, financial services, and macroeconomic and climate scenario forecasting and analysis. So I'm going to ask our panelists to come on up and we'll get started. Panelists 2 questions on their respective subjects' area of expertise, and the answers are limited to 2 minutes each. So I'm going to start with Francis.
Frank touched on it, and I think everybody here knows that the traditional role that the insurance sector plays is to signal risk. And I think one of the fundamental challenges it's facing today in doing that in this environment is that the tools that it has, the approach it takes, as Frank indicated, is easier for backward-looking. So this might be a little duplicative of Frank, but you know there are regulatory issues. Frank touched on them. You know, an insurance commissioner, her job is both 2 jobs basically, both to ensure availability and affordability of insurance, but also to maintain the solvency of the insurance sector. Those are in conflict. They're at least on each side of the seesaw. That job is becoming more and more difficult, and as companies start to feel the distress, it's going to become more political, as we're already starting to see. There's also a temporal mismatch, as Frank referenced. A 12-month insurance policy up against the evolution of a risk that may take 5, 10, 15, 20 years to manifest is difficult to send risk signals about when you're really mandated in a 12-month insurance policy. Probably the fundamental one, though, I'd say, is that we, as an insurance sector, send the way we incentivize behavior, and we are incredibly effective at doing this in certain areas, but we do it at the individual level. You know, we can incentivize you through policy language, through discounts, through this or that, kind of manipulate you or choreograph kind of what you're going to. But that's at the individual level, and this risk is at a community level. So we're sending signals at an individual, but you're not going to go out and build a seawall. You're not going to go out and build a nature-based solution. So the signals we're sending are actually incompatible with the solutions that are needed. So I'd say that those are maybe the beginnings of why that risk signaling role we typically play is becoming muted.
Thank you. Thank you, Francis. One other question for you. What role do innovative insurance products or solutions play in addressing climate risk, and can you provide examples of such initiatives?
It's what this is all about, right? I mean, Frank says the new business model, the whole CIRCAT effort is going to be to try to galvanize and catalyze thinking around new products, new approaches. I'll cite two that are potentially revolutionary if they can be kind of harnessed perhaps and applied. One is parametric. So in a very, very quick way, parametric is, you're no longer kind of individually underwriting and claims, adjusting claims. You are using a common, basically third-party approved trigger. And as long as that trigger is met, the payout is made. So you don't go back and look at, did you lose your house or did this happen to this? If the trigger happens, you get a payout. The administrative ease that creates allows you to start to really think about risk in a different way. For the company I'm with, we have utilized parametric as the basis for community-based catastrophe insurance so that we can, if one flood level is reached, the payout is made in the entire community that's identified as a beneficiary, get the money, as opposed to having to go to house by house by house by house by house. So there's an incredible efficiency factor. There are other downsides of parametrics that need to be addressed, but there's an incredibly efficiency factor. The other thing parametrics are allowing is something that's totally revolutionary. You want to talk about a new business model, anticipatory finance. So this is where you can actually set a trigger and have a payout before the harm occurs, so that you could put money in people's pockets to do something, to take an action, to avoid the harm, to move out of harm's way, to move their family. This sounds kind of radical here, but it's being used already in the Philippines and in Indonesia and in a lot of developing markets where a lot of these innovations are happening. The other one I'd cite, but very briefly, would be the evolution of blended finance. And again, in the developing world space, this is old hat. I mean, this is something that's used a lot. It's not something you see a lot in the developed world, but it's one that we are going to have to get comfortable with as the insurance sector, that when we go to a community or we go to an individual or we go to a large risk-bearing entity or risk-posing entity, insurance might not be the only solution. Blending it with philanthropic, impact investment, traditional return investment, insurance on the top. So you're almost stacking return expectations in a way that actually provide the risk transfer capabilities.
Thank you. All right, we're going to move on to our next contestant. So Mahmoud, I have questions for you. How does Boston Consulting Group integrate climate risk considerations into financial planning for financial institutions and decision-making processes?
Thank you. Thanks for having me. So we think of climate risk management as requiring a transversal framework, meaning that climate risk should be embedded in all parts of the risk management framework rather than just a standalone kind of climate capability. The framework covers three high-level areas. The first is strategy, vision, objectives. So what are our objectives as an organization in terms of climate risk? Do we want to be ahead of the pack? Do we want to be behind? Do we want to lead? How should we think about that? The second portion is capabilities. What do we think of, or how do we want to build out our scenario analysis functions, stress testing functions, and modeling capabilities? And then the final part is enablers. So how should we embed climate risk in process and controls, talent management, and technology and operations?
Sorry, we have to share that. Second question is, can you elaborate on the specific financial metrics or indicators that Boston Consulting Group uses to assess exposure to climate-related risks?
Yeah, absolutely. So I would say there are three main categories. The first is transition risk, physical risk, and then just the financial metrics. In terms of transition risk, we're looking at metrics such as carbon intensity. So how carbon intensive is a particular organization or company. We're also looking at kind of policy level, macro level policies like carbon taxes. So what are the potential carbon taxes? How could they impact profitability at the company level? For physical risk, we're looking at climate perils, their expected severity and frequency. And then finally, for financial metrics, we're mostly focused on credit risk metrics, meaning what is the potential impact on probability of default, loss given default. So if we extend a loan where there's a lot of climate-associated risk, what is the probability that the loan will be repaid?
Fantastic. Thank you. All right, moving on to Roger. First question for you is, can you explain the methodologies and models Verisk uses to protect and analyze potential impacts of climate change on catastrophic events, and how often are these models updated?
Okay, yeah, thank you. Good question. The specific techniques will vary depending on the type of peril, but broadly, the problem we're solving is one that Frank alluded to in this challenge of having basically a data poor environment. So you've got very low frequency events that have very high severity, a large correlation of losses amongst the portfolios and the policies in a portfolio. And so the historical record isn't sufficient, and so what we do is we build basically a simulated loss experience through Monte Carlo simulation and other techniques to basically give them a sense of what the probability distribution of losses look like. Broadly, we're not downscaling climate models. So if you're familiar with how GCMs work, we're not downscaling those models. We're actually building the models more from the ground up. So whether it's coupling a numerical weather prediction model with a hydrology model and a hydraulic model is one technique. But broadly, the goal is to create a physical representation for each of the events that are being created. So that's one component. That's this hazard component where we've got thousands or millions of events in the catalog. We have a separate component, which is the vulnerability, which is given the event has occurred, what's the damage to the building? And then finally, there's a financial component, which is given that the damage has occurred and there's a financial structure around how the policy is supposed to work, then we model all of that. So all three of those components are important. I know we'll probably spend a lot of time talking about hazard, but wanted to just point that out. The models are built at a continental scale generally. So our business problem is that an insurer can effectively show up at our door or in the software with any address in the United States, and they need to be able to get a risk estimate for that location. So and then the models themselves are essentially built into a software platform that gets pretty deeply embedded into the insurer's workflow. So that starts to play into how frequently do we update the model. So we're always interested in getting new data, particularly when the new data tells us something new about the risk. Very frequently, there's some new line of business or some behavior of a certain asset class that we learned something about based on the claims experience. But we always have to balance that against the disruption that will occur by frequent model updates into the business process. So the sort of rule of thumb is if you have a good model, it shouldn't overreact to a single year's worth of loss experience. So that's just something we keep in mind. So I'll stop there.
Okay, great. Thank you. All right, your second question is, can you provide examples of how your catastrophe modeling has influenced risk mitigation and insurance product development to address climate-related challenges?
Yeah, thanks. So actually, I guess I've got three examples. So the first was actually Frank alluded to Hurricane Andrew. So that was really the beginning of the catastrophe modeling industry. And so that was really when insurance companies turned to catastrophe models to come up with a better way to estimate the risk. The other thing that happened is that there was a lot of research. There were new building codes enacted. And those make their way into our models, and particularly that vulnerability component. And that becomes one way that you can begin to sort of send the right pricing signals. So now insurers can differentiate between different types of risks, offer discounts, and so on. So the models become a way where this practical research actually has effect on the market. So that's one example. The second thing, Frank had that chart that talked about the reinsurance and alternative capital. The models provide a currency with which risk can be transferred. So it's, not everyone's going to agree on exactly what that exceeds probability curve looks like, but it does sort of create kind of a common framework. And particularly with this alternative capital that comes in through the capital markets, that's really important for them because they have confidence that the models are giving them a sensible view of risk, and that pool of capital is much, much bigger than the traditional reinsurance capital. And the last thing I'd say is around the protection gap, and Francis and I were talking about earlier, there is a lot of innovation happening in the developing world. So those, developing countries don't have the sort of discretionary budget to pay out significant funds following an event. So our models are used to create, help inform parametric structures or other types of financial risk transfer mechanisms that result in liquidity. So that's, again, the developing world has a lot of, by necessity, I think, has a lot of innovations to offer.
Great, thank you. Moving on to Allison. How do communities currently perceive and prioritize climate-related risks, and what initiatives are in place to address these concerns?
Yeah, great. My experience is mostly on the Gulf Coast, and I want to start out by saying that it really depends on what you mean by community, right? Most of the, there is a wide variety of capacity issues along the Gulf Coast and elsewhere. But my experience with these communities is that they are very focused on hazards, and they understand hazards. Or, excuse me, this is an insurance meeting, so I think I have to say perils. They know them. But there are also a lot of fence line or frontline communities in Louisiana that, they are also focused on the intersection of those plus pollution and toxics. And so that's where you get a lot of environmental justice work. Still other communities are just really keyed in on growth and jobs and economic development. But I think the common thing is they understand the impacts, and you can talk to these folks about coastal erosion, about high tide flooding, about road washouts, and about damage to structures. They know all of this stuff, and they just might use different words to talk about it, right? If we break down the components of vulnerability and we talk about adaptive capacity and sensitivity and exposure, they know all this stuff and they talk about it all the time. They just use different words. You might not say climate change, but you can say coastal erosion, and they care a lot about it. I think in terms of initiatives, there is more federal money for this than maybe ever, especially with IRA and IIJA. But the issue is capacity, grants. All of this funding, most of this funding is grant-based, and grants are really, really difficult. They're difficult to put together. They are difficult to budget for. They're difficult to administer. Some of these communities already have full portfolios of CDBG-DR funding. And if you've ever dealt with HUD funding, you know it is a royal pain in the butt. And so I would say that funding needs great bureaucrats, and so those are in short supply. And so these capacity issues really need to be front of mind when we're talking about just about getting money. Money isn't the only thing. One example from that is in New Orleans, a previous mayoral administration worked to get a settlement from FEMA for road damages after Katrina, and they ended up getting over $1 billion in this settlement. FEMA agreed to pay out for these damages that occurred. New Orleans has had a tremendous difficulty getting that money out the door and getting those projects done. So capital projects administration, grant administration, preparing for federal audits, all of this stuff is super time intensive, and not every community can do it.
Great, thank you. Second question, how does the Water Institute engage with local government, local businesses, and other organizations to develop and implement climate action plans?
Yeah, great question. I think that when we talk about climate action, I think most of the time you're talking about the mitigation space, right? You're talking about greenhouse gas emissions mitigation. And so at the Institute, we have done a lot of that work, especially with the state of Louisiana. We worked with the governor's office to develop a first ever climate action plan in the Gulf South, which is a really big deal because Louisiana has, I think, the 4th largest amount of emissions in the country, 2/3 of which are from industry. So it's an incredibly difficult place to do climate work. And we used some really cool decision science techniques to help keep industry and environmental justice advocates at the table for that process. But I think really here we're here to talk about adaptation. And Louisiana has a long history and experience with adaptation planning in particular. The National Disaster Resilience Competition, which was during the Obama administration, Louisiana was awarded funds from that, part of which went to the development of LA Safe, which was a really landmark adaptation plan that set out some guidelines for how adaptation should happen, including that when people have to relocate, you should try and keep them in the same parish or county, in part because you want to keep that tax base whole, because if you don't, it makes it a lot harder. But I also want to mention that at the Institute, we are standing up this, our Gulf Center for Equitable Climate Resilience. And so this is a space for us to build long-term relationships with communities and really invest time into specific communities and be intentionally thinking about near-term and long-term resilience issues, and specifically how you bridge the issues of right now to the issues of the future. At the Institute, it's great because we have this nexus of incredible research capacity and expertise in decision making, and so the center really puts us in a place where we can try some new stuff and just take some creative risks and then embed it into local community decision making processes. But specifically on that like near term, long term thing, I think a lot of places I'm seeing this more, that they know that there's going to be incredible climate consequences like sea level rise in 50 years, but they can't even think about that yet because they're like, okay, but how do I manage this road for the next 20 years, right? They need to know what height do I need to build this bulkhead to? And how do you help them figure that out? That is like the main need in terms of community decision making is trying to use long-term information for near-term decision making.
Thank you. All right. We are ready to move into our next lightning round. This is our research need focused lightning round. So we're going to have questions related to the research topics we're going to explore tomorrow during the workshop. So our first research theme is around technical assistance and community insurance options for underserved and overburdened communities. So my first question goes back to Allison, which is what kinds of data are communities lacking and what's the effect of that on planning? And you started that already, but maybe just a quick addition.
Oh, I can talk about this all day. I think one of the big needs is for high resolution, spatially explicit data on future flood risk. I think everybody needs that. But it needs to be accessible and it needs to be usable so that it informs those kinds of very practical decisions that I just talked about, like what height do I set bulkheads at? If they don't know how to access NOAA's sea level rise projections, then that's not a usable data set for them, right? Another thing that we heard a lot in our recent kickoff symposium for the Center for Equitable Climate Resilience was the need for higher resolution socioeconomic and demographic data to assess community climate vulnerability. And we're talking at like very small scales. So to help inform climate plan or vulnerability assessments for very small communities. On the damage modeling side, getting great information and maintaining and updating it on the structures themselves is really difficult. I'm sure, Roger, you can talk about that too. For Louisiana's Coastal Master Plan, the structure inventory was derived using work by David Johnson from Purdue, using Google Street View and some machine learning techniques to build a structure inventory for the entire Coastal Master Plan region, which is most of the southern half of Louisiana. That's not something that a lot of communities have the capacity for. Same with like maintaining a database of elevation certificates, and that gets into building code enforcement too. If you're talking about substantial damage and reaching those thresholds of when you need to elevate and enforcing updated building codes, accessibility and usability of all kinds of data really hinders some of those planning needs for longer term land use and development.
Thank you. All right, Francis, is there precedent for the insurance sector sharing knowledge to help others manage their risks?
Oh, yeah. In fact, I'd say perhaps the two most societal or socially beneficial risk management success factors or success stories that the insurance industry has are not about transferring risk. I mean, it's what we do. It's how we make money. But if you look at past complex societal exposures, sometimes it's not always the right way to do it. In 1892, the World's Fair was being held in Chicago, and it was going to be the first time that large-scale deployment of electricity was going to be used on the planet. So some inquiring and nervous insurance executives in Boston sent an MIT engineer over there. and said, figure out what the hell's going on, because this scares us. Because remember, back then you had people, most people lived in wooden buildings, and factories were made out of wood and whatnot. And here was this thing that sparked and whatnot. The engineer made his way back to Boston and said, yeah, you're right, this is going to be a mess. But rather than do what the insurance industry is doing today, which is scale back and exclude or price higher, what the insurance industry decided to do back in 1872 was actually take its knowledge, combine it with engineering knowledge, create an entity that actually looked at electricity as a social good where the risk had to be reduced. So they created Underwriters Laboratory. And today, there's not an electrical appliance that gets into the hands or on the table of any home probably on the planet that the insurance industry hasn't touched, hasn't looked at, hasn't approved. So I don't think it's a stretch to say that the insurance sector made the world safe for electricity. And we can do that again. They did it again, we did it again in the 1950s. So President Eisenhower opens up the superhighways designed for tanks, but okay, we'll drive on them as well, right? And that meant not just more cars, it meant bigger cars, it meant faster cars, which from a physical perspective means a very different risk profile. But again, rather than every insurance company saying, I've got to figure out what the risk profile of this car is, we came together as a sector and created something called the Insurance Institute for Highway Safety. And today, there's not, I mean, you watch anyone who watched the Super Bowl probably saw 10, 20, automobile ads, and they're all citing their IIH safety ratings. So the insurance industry became the de facto regulator of automobile safety on this planet. Now, that's without a dime of risk transfer. That's a knowledge approach. That's a risk reduction approach. So there is precedence, and I would say it's probably the two biggest almost success stories we have as an industry are actually around how we take our knowledge and apply it differently. In that it's a good indicator, because I think the industry today still thinks risk transfer is the only role we play in climate, and I think it has to open its eyes and recognize that risk reduction is the only way we're going to have risk left to transfer.
Thank you. Great examples. All right, Mahmoud, for you, do municipalities, counties, or states face unique challenges when tracking their financial exposures to climate change?
Thank you. So I think in terms of state and local governments, they have additional factors to consider, such as impact on infrastructure. So I think Frank touched on that earlier. But they also need to think about the economic risks that they face and the potential impact on tax revenues. So for example, something like a wildfire has second and third order impacts at the state and local level. So a wildfire, for example, could damage the local tourism industry, which could lead to rising unemployment, which could lead to rising defaults, which could lead to falling housing prices. So kind of figuring out how to assess the second, third, and maybe potentially even fourth order impacts is critical for local, state and local governments.
Thank you. Roger, how do communities access insurance data and modeling today?
So it's a good question. I would say by and large, communities aren't really utilizing insurance in any appreciable degree. I mean, the public assets will often be insured, so the municipal buildings will be insured, and the work that's done to place that insurance is usually done by a broker. But in terms of the types of analytics that an insurance company is doing, that's largely absent from the toolkit of most insurance companies, of most communities. And that's largely because what we were talking about before is that really all the funding comes from the federal government. So there's most of the risk managers that I talk to are hyper-focused on understanding which grants they need to apply for and how to administer and manage those. And they're not at all thinking about insurance risk. So that's the short answer, I guess.
Okay, we're doing short answers today, so that's perfect. Okay. Our second theme is strategies for managing climate-related financial risk at the firm and systems level. So this group will explore how inadequate management of climate risks could create system-level risks. Sounds a little bit like what you were just talking about. So I'm going to start with you. Mahmoud, what are the main financial risks facing firms due to climate change, and what are the emerging best practices for managing them?
Thank you. So I'll talk about financial firms such as banks, but banks tend to think about risk in terms of risk categories or risk stripes. So the main ones are credit risk, market risk, liquidity, operational risk, and others. Credit risk is really the main category that they're focused on in terms of climate risk assessment. And in terms of credit risk assessments, the way that banks think about it is there's a kind of a range of approaches ranging from just doing a 1 to 2 notch credit downgrade, just kind of a simple kind of analysis. And then there's climate scenario analysis, which also has a kind of different levels of sophistication. But some of the best practices that are emerging are the use of climate scenarios, such as NGFS, Network for Green Financial System, which looks at transition risk as well as physical risk. There are also climate or physical risk scenarios such as the RCP scenarios. So some banks are starting to use those scenarios and downscaling them at the kind of state and local or county level, sometimes even down to the property level, to assess the risk on their lending portfolios.
Thank you. Moving on to Roger. Modeling trends to focus on peril-specific loss estimates. Have you seen firms using your modeling tools to project financial risks more broadly?
Yeah, there are a couple of use cases. So one is corporations more broadly will use models to get an estimate of basically their business continuity risks. So understanding which parts of their operations are potentially exposed to climate risks and other sorts of risks. Or if they're expanding in a particular region, just trying to do site selection. That's one example. A second example is actually a really interesting problem around supply chain risk. So 2011, there were 2 major events in Asia. There was a Tohoku earthquake in Japan, and then there were a bunch of floods in Thailand. And those sent, obviously a lot of manufacturing, particularly in the automobile and electronics industries that were disrupted, significantly disrupted. And those had cascading effects into other parts, or really all around the world. And so that's a super interesting problem to model. The problem is nobody has very good data about their supply chains. They understand their first level, their suppliers, but they don't really understand their suppliers, and that's where that problem breaks down. So it's a fun problem, but it doesn't have any data. And then the last one I'd say is mortgage risk. We're definitely seeing more interest from mortgage companies and other entities. They're particularly concerned about this erosion of insurance protection. So first of all, no one really thinks about earthquake for whatever reason. They just don't, because they don't happen very often. They understand the flood risk, but there's a sort of presumption that if you're having a federally backed mortgage that you have flood insurance through the NFIP. Whether that's true or not is a separate question. But there's always been this assumption around, well, if wind risk is covered, severe thunderstorms are covered, wildfires are covered, and now as you begin to see erosion in those markets, that's getting people's attention.
Great, thank you. Francis, how are insurers the ultimate risk takers managing their financial exposures?
I think we've been touching on this topic a little bit already this afternoon. Maybe I'd start off by saying, if you look at the TCFD filings, the Task Force for Financial Climate Disclosures, of the major insurers, and I've helped develop some of these disclosures as well, they're almost identical language. You would think that you'd think BCG was consulting all of us, right? And basically what they say is physical risk exposure is not a big deal because, as Frank said, we can either reprice or withdraw capacity. Now, I don't know if that's as accurate as we say in this TCFD filings, but that is clearly the primary tool that the insurance companies are using to manage the financial exposure is repricing or withdrawal. Now, there are many other tinkering with your book of business that you can undertake to have the same effect. Diversification is the key one. If you're overexposed in this, you try to pick up more of that and slightly pull back. And Roger's company my company helps companies do that as well. So diversification is is kind of a magic sauce, of insurance companies, because if you're overexposed in anything, the chances are bad that you're going to make money on it. The reinsurance markets are readjusting, meaning the retentions that are being held by the insurance companies themselves are going up as the price of reinsurance is going up. So that's opening up different risk-sharing approaches and revisiting again of certain geographies or lines of business. So it's really all-encompassing. But at the end of the day, it's really about pricing. And there was a Financial Times article 2 days ago, I think, which was a very interesting article about homeowners insurance and the price being paid by homeowners for this. And there was a quote in there by the CEO of Swiss Re, Christian Mumenthaler, which I thought was spot on. I wish I had said it first. But it is that what we're seeing in the homeowners crisis, particularly in America and in Australia, which are the two markets where this is really playing out, is the first consumer carbon tax. So consumers, not companies, but consumers are finally being charged a price for, what was it, Frank? The Feast of Consequences that you started out with, that pretty picture of you in college. That is finally coming to roost. The risk is finally being charged, and I can assure you it is not being welcome.
Thank you, I think. So, Allison, when you're working with a community, how are they talking about financial risks?
I mean, I think every community is concerned about their muni bond rating. Like, that's just a pretty universal experience among elected officials of all kinds. But I think if you're talking to neighbors and individuals, they are experiencing the consequences of their insurance prices going up. But there's not a lot they can do, right? They might, and I say this because I'm one of these people who received a price signal and I sold my house, right? But somebody else bought it. And so the cycle continues. And so there's not a lot that neighbors can do or homeowners can do. And we are not even talking about renters and the dilemmas that they face. But even just sticking with homeowners, there's not a lot they can do other than just move or stay. And they want to stay. I think having discussions about relocation is the most difficult thing in this entire space. And people don't even want to bring up the word buyouts because it's like a bubble pops if you say it out loud, because it takes away that growth-oriented future, right? Maybe like 10, 15 years ago, Detroit and Youngstown started saying out loud that they were planning for population decline. And that was a huge change because no other city in any of their master plans had ever said, we don't think population will grow and we aren't going to plan for it. And if you're changing that paradigm, then, I think there's a real question of what people should do when they receive these price signals, right? Because they don't want to go anywhere. It's their community. And we know also in the research, like Eric Kleinenberg and Palaces for the People, that like community is not a nice to have. It is absolutely necessary for survival. Yeah, it keeps me up at night. I don't really know what the answer is. I guess we moved on from financial, but it's all linked together.
It is all linked together. Thank you. All right, our third theme is assessing the risk reduction effectiveness of climate resilience and adaptation projects. So that the National Academy study on standards and kind of coming up with a resilience standard seems very relevant to this work. Roger, start with you. Can you explain why it is so challenging for professional models to take into account local risk reduction initiatives?
Yeah, I'd say that it always comes back to the data for us. So local risk reduction efforts can absolutely be taken into account, provided that the data is is of high quality and in a collected format that we can access. So if you've ever done flood modeling at any large scale, you'll recognize that there's no database of levees. And levees are a pretty important flood protection measure, but there's no place you can go and find a list of all the levees in the United States or the community drainage, for example. So that's a challenge for the problem we're solving, is that we need some consistency in the data. We need it at scale. So that's one example. And I guess the other thing I'd say goes back to the challenge I talked about before, sort of balancing the update with the business problem that our clients are solving. So getting access to new data is something our scientists and engineers really love, but they also spend a lot of time vetting that data, evaluating whether it makes sense. If you've ever worked with data, we can't just take that data and plug it into the model and see what happens. We've got to do a lot of work, so that takes some time. I'd say one other challenge that I think we'll gradually overcome, or at least be able to address a bit more, is around technology. So today, most of these insurance companies are doing this modeling kind of in-house, meaning they're using our software platforms in their own environments. And as you move to the cloud, as we start to take advantage of those technologies, and there's a lot of data privacy concerns and things that have to be overcome, but that enables a number of better modeling techniques, more frequent updates. So those sorts of technologies I think can help. But again, that's really around the business problem we're solving.
Thank you. Mahmoud, how would or could public and private institutions capture the financial benefits of climate adaptation projects?
Yeah, thank you. So I think first, sorry, it's a little loud. I would say the first benefit of the climate adaptation resiliency projects is that it limits the downside for everyone. So that's a huge benefit. Second, I think there's a lot of public-private programs that could be kind of structured where publicly backed loans could be provided through financial institutions. So that's certainly something that we have plenty of examples of. And I think the third area, which I think Frank also somewhat touched on earlier, is through the government-sponsored enterprises like Fannie Mae, Freddie Mac, we could start providing kind of loans that have favorable terms for properties that are certified for climate resiliency. If I look at the green lending market today, it's primarily focused on energy transition. So I think there's a significant opportunity for resiliency kind of bonds.
Thank you. Allison, would the ability to credibly identify the financial benefits and beneficiaries of a climate risk reduction project make it easier for low-income communities to access funding?
I think theoretically, yes. And we're actually doing a project soon to test this out in coastal Alabama, where we're going to look at a marsh restoration project that was done and talk to all the homeowners nearby and work with the engineers who built the project. They're going to remodel the change in total water levels expected from the project. And then we're going to talk to all these homeowners. Then Munich Re is our partner on this, and they're going to figure out what that should translate in terms of their flood insurance premium. And then we're going to talk to all the homeowners and give them information to go fight with their insurance company about it, which I'm really excited about. But Dauphin Island is not a low-income community. They, this marsh restoration project came as a result of like really committed local planning over the course of many years since the oil spill, in which I don't even know if that made the catastrophe timeline. We've had so many. So I would say there are a lot of other barriers to community scale risk transfer beyond just like identifying financial benefit. This is not a case, I think, where you can compare two BCRs and pick the higher one. These projects need to incorporate that adaptive capacity and sensitivity. If you're talking about like a CBCI, you got to go door to door and sign people up, right? Like who's going to do that? So you need partners who are going to, who have really deep roots in a community to be able to get people on board with this. So there's, I think, yes, theoretically, yes, but there are a lot of barriers to doing this successfully.
Thank you. Francis, can you provide any examples where Marsh McLennan may be pursuing the same objective?
Yeah, and I think this is a bit of a holy grail bit as well, right? Because the insurance industry for years has been out front talking about $1 invested saves, you pick your number, 5, 6, 7, 10, 12. And I think theoretically we all believe that, but my the question I would ask is, well, where is the 6, 7, 8? Who gets it? Show it to me. Put it in my pocket or put it in someone else's pocket. And I think the insurance industry is missing, again, another social value we could play by helping to capture and identify or monetize even the benefit from some of the steps that some of these communities are going to make. So we are engaged right now in a project in the Milwaukee watershed where Ducks Unlimited has been brought in to build 4,000 acres of nature-based solutions with restored wetlands and reforestation along the rivers. And what we're trying to do is to use CBCI, community-based catastrophe insurance, because of the scaling effect it can have. So, you know, DU can build their restored wetland, and you can go to, you know, the 100 insurance companies that are insuring the 10,000 people in the town below, but that's friction filled, you know, and the benefit to each individual homeowner is going to be 5, 7, 10, 20, 12. It's just going to be hard to really capture and get people excited. By using an aggregation technique like community-based catastrophe insurance, you could actually scale the benefits, right? So you could start to get, okay, 5% of a $1,000 insurance policy, okay, 5% of a $2 million insurance policy, you know, you're actually starting to get dollars that you can capture and do something with. Our hope would be you then reinvest that money back into more risk mitigation. The key, though, to Roger's point, is the data. So we are working directly with the city of Milwaukee sewage district to really ensure that we're capturing the data in the right way, that we're translating what they need into insurance speak, so that it can be hopefully developed into a framework, scaled, and used. And companies like Verisk and others can recognize it, and we can start to create that database of nature-based benefits that go to communities and can then be reflected in insurance pricing.
Great, thank you. All right, moving on to our fourth theme. In this theme, we're going to have to do a speed round, so we'll have 1 minute per answer. We're going to explore current risk modeling, communications, and risk management, and where they fall short on evaluating and addressing risk associated with multiple climate hazards, and how modeling multiple hazards together could expose additional vulnerabilities. So, Allison, I'm going to start with you. In the communities you're working with, do you find that leaders are understanding and addressing the multi-hazard dynamics, or do they tend to lock on to a single threat at a time?
I don't think there's a community leader in the Gulf Coast who has the luxury of focusing on one threat at a time. You know, you look at communities like Lake Charles, they are getting, you know, they got winter storm damage, they get sunny day floods, they get hurricanes. We had a global pandemic. There's nobody who can deal with just one thing at a time. So, but I think when it comes to modeling those things and incorporating that into long-term land use planning, no, there's no, like, that is not, Louisiana is working on compound flood through the watershed initiative and some other things, but, you know, I think being able to look at more than one source of peril risk at a time, that is, in terms of planning, that's not there yet.
Thank you. Roger, how does the private sector manage or recognize the relations between various hazards when developing risk models?
So really every one of our risk models has a multiple hazard component. So our hurricane model would have hurricane wind, precipitation-induced flooding, storm surge. So that's an important part of the business because you need to account for the damages to different perils and the insurance coverages that are associated with that. I would say that as we think about climate change and the way insurers are using the information. So our models, the goal of our models is to really give insurers a view of sort of the near present climate. And so while we are looking backwards, we have to look backwards because there's a certain amount of data there that you can use to validate your model. We do have to be very careful about how we treat that data. So the big risk or a big challenge for us is sort of separating, identifying trends in climate data, figuring out which ones are, you know, statistically robust, and then separating what might be a climate trend from, say, just a regular climate variability. So there's a lot of challenges around that. But yeah, that's fundamentally how we approach these, is a multi-hazard problem.
Thank you. And Mahmoud, Does the possible relationship between one risk and another make it harder or easier to understand and manage the financial impacts?
Yeah, I think it certainly introduces complexities because the interaction between multiple risks will often lead to nonlinear outcomes. So two independent risks could each have an impact of X, for example, but if they occur simultaneously, the impact could be 50X. I think related to that is when we think about modeling some of these scenarios or risks at the systemic level, there's often a question of where do you cut it off? Do you do first order impact, second order impact, third order impact? It could very quickly spiral into Armageddon. So there's a question like where do you stop?
Thank you. Thank you all for your speed answers. Really appreciate it. I know we haven't had time for Q&A, but please stay around for the reception to ask questions and chat with our panelists and our speaker. Thank you. Mark.
Thank you, Lydia, and the panelists for a really informative discussion. I know that some of you in the audience have worked in the areas of insurance and finance, but I think probably for many of us, we've learned a lot today that this is new information. So thank you for educating us on many of these issues. I hope that as you listened, you heard some things that could connect to your own areas of interest and research, as I mentioned at the beginning. Even if you don't work in these areas specifically, I think you probably heard some indications of the broader needs and where a variety of different disciplines and a variety of different research tracks could come to bear. And indeed, what I heard from the panelists is more specific expertise in insurance and finance isn't necessarily what's needed to address these thorny problems. Rather, some fresh and innovative ideas that come from the fields of engineering, law, policy, environment and ecology, the social sciences, data science, statistics, and decision theory. Even more importantly, are the interdisciplinary ideas that stem from all of these and can be combined across these, the interactions among these fields. In other words, what I heard is they need the strengths of Duke, really. So I hope that tomorrow, many of you who are joining us for the working part of the symposium will bring your insights and ideas and energy and be ready to actively engage your colleagues and the guests in bringing Duke's strengths to bear on these challenging situations that we heard about today. I mentioned earlier that this week's symposium was organized by Duke Climate and by the Nicholas Institute for Energy, Environment, and Sustainability. So at this time, I'd like to specifically thank Philip Hollingsworth, standing in the back here. He's the Senior Program Coordinator at the Nicholas Institute. Philip supports external engagement pillar of the Duke Climate Commitment and the Climate Leaders in Residence program. And he's played an essential role in organizing many of the parts of this symposium. And also, yeah, thank you. I'd also like to thank William Ferris. Will, you want to stand up? Will is the Executive Director of Duke Climate, the new institution on campus that I mentioned. Just for those of you who might have been wondering the relation, I got some questions. Duke Climate you could think of as Duke's contribution to this upcoming center called CIRCAD that we've been referring to, which is the NSF and NOAA sponsored center, which would have contributions from other universities, including the University of Georgia, from which we have a couple of representatives here today, and potentially other partners. And Duke Climate will also be engaging in other activities around climate risk and resilience beyond just this IUCRC. So Will is the Executive Director of Duke Climate. He was really instrumental in conceiving and implementing not only the conceptual, but also the conceptual and the practical aspects of the symposium. So again, thank you, Will. So I want to thank Francis Bouchard, who by agreeing to come to Duke as the inaugural climate leader in residence really jump-started our efforts to engage with the insurance and finance industry. And I want to thank Lydia Olander, who's taken the considerable task of not only co-leading this particular symposium, but also overseeing the entire Climate Collaboration Symposium series. Speaking of, the next in the series is on sustainable infrastructure, and that will be held from March 20th to the 22nd. So keep your eyes open for more details on that. I see that the food and the drinks have been set up in the back, and I don't want to keep you from that any longer. As you mix and mingle to meet each other, I'd encourage you to make a point of introducing yourself to someone new. Part of this is about developing new relations and new collaborations. And I might suggest a conversation starter. So what's your big idea on managing climate risk? Thank you.